The Indian stock market did not appear overnight. It began with a simple idea. Businesses needed money to grow. People with savings wanted their money to grow. A marketplace could connect them. This was the seed. It was planted in a land ready for new ventures. The late 19th century was a time of change. India was under British rule. But Indian enterprise was stirring. The need for a formal place to trade shares became clear. This was the start of a long, fascinating journey for investors. Before grand buildings and computer screens, there was a tree. Yes, a banyan tree in Bombay. This is where early brokers met. They gathered under its shade. They discussed deals and struck bargains. It was informal. It was based on trust and word of mouth. Cotton was a big commodity then. The American Civil War had disrupted cotton supplies. This gave Indian cotton a boost. Trading in shares of cotton mills became active. These early pioneers laid the groundwork for something much bigger. They were the first beasts of the market. The informal gatherings needed structure. This led to a historic moment. In 1875, an association was formed. It was called the Native Share and Stockbrokers Association. This was the foundation of what we now know as the BSE, or Bombay Stock Exchange. It was Asia's first stock exchange. Imagine the scene, a group of brokers deciding to organize. They created rules. They found a dedicated place to trade. This was a huge step. It brought a semblance of order to the nascent market. In those early days, the market was small. Only a few companies were listed. These were mostly textile mills. Banks and plantation companies also featured. The number of investors was tiny. Investing was not for everyone. It was seen as a risky game. Only the wealthy or the very adventurous dared to enter. Information was scarce. Decisions were often based on whispers and rumors. The market grew slowly but steadily. It was building experience, one trade at a time. It was learning its first lessons in bulls and bears. After India gained independence in 1947, the market faced new realities. The government played a strong role in the economy. The Controller of Capital Issues, or CCI, was established. This body decided which companies could raise money. It also decided the price of shares. This was meant to protect investors, but it often stifled growth. The market remained somewhat subdued for many years. Free pricing of shares was a distant dream. This era was characterized by caution. Big booms and busts were less frequent. The beast of speculation was somewhat caged but restless. The 1980s brought a fresh breeze. This decade saw the rise of a new investing class. Dhirubhai Ambani and his company, Reliance, played a big part. Reliance held its annual general meetings in stadiums. Thousands of small investors attended. They were drawn by Ambani's vision. He made them feel like partners in growth. The cult of equity began to spread. Ordinary Indians started investing in stocks. They hoped to create wealth. The market was no longer just for the elite. It was becoming more democratic, more vibrant, and more volatile. Then came the storm. The early 1990s were a period of economic liberalization. The markets were excited, but this excitement was exploited. Harshad Mehta, known as the Big Bull, orchestrated a massive scam. He manipulated stock prices. He used money siphoned from banks. Prices of certain stocks shot up to dizzying heights. Many investors jumped in, chasing quick profits. When the scam unraveled in 1992, the market crashed. Fortunes were wiped out. It was a brutal lesson. The system's weaknesses were cruelly exposed. The beast of greed had run wild. The Harshad Mehta scam was a wake-up call. It showed the urgent need for reforms. The Securities and Exchange Board of India, or CBI, was given more powers. It became a true market regulator. Rules were tightened. Surveillance was improved. A major change was the move to electronic trading. The old open outcry system was replaced by screens. Dematerialization, holding shares in electronic form, was introduced. This made trading faster, cheaper, and more transparent. The market began a slow process of cleaning up its act. It was maturing, forced by crisis. Bull markets are intoxicating. When prices are rising, everyone feels like a genius. Greed takes over. Stories of people making fortunes quickly spread like wildfire. Your neighbor, your colleague, even your barber seems to be minting money. The feeling that you are missing out becomes unbearable. This is when caution is thrown to the wind. People invest money they cannot afford to lose. They borrow. They take huge risks. The market seems like a magical money-making machine. This euphoria is a dangerous psychological trap. It blinds investors to underlying risks. The fear of missing out, or FOMO, is a powerful driver. It pushes people to buy stocks at inflated prices. They see others getting rich. They don't want to be left behind. Logic and analysis take a back seat. The herd mentality kicks in. Everyone is buying, so it must be the right thing to do. This collective emotion can create massive bubbles. People start believing this time is different. They ignore warning signs. I have seen individuals mortgage their homes. They put their life savings into stocks based on a hot tip. The results are often tragic. Then the music stops. Bear markets arrive. Panic replaces greed. The same investors who were euphoric now feel despair. Prices fall sharply. Losses mount. The dream of quick riches turns into a nightmare. People rush to sell, often at the worst possible time. They just want to get out. The pain of losing money is intense. It leads to blame. Investors blame brokers. They blame the government. They blame manipulators. Hope vanishes. Capitulation sets in when even die-hard bulls give up. This is often the point of maximum pessimism and sometimes a turning point. Investor psychology often follows a predictable pattern. It swings between extreme greed and extreme fear. The herd mentality is very strong. Most people find it difficult to go against the crowd. When everyone is buying, it feels safe to buy. When everyone is selling, it feels right to sell. Tips and rumors become more important than fundamentals. True contrarian thinking is rare. It takes courage to buy when others are panicking. It takes discipline to sell when others are euphoric. Understanding these emotional cycles is crucial for survival and success in the stock market. Market manipulation is not just about grand scams like Harshad Mehta's. It exists in many forms. Some are less obvious but equally damaging. Price rigging is common. A group of operators might artificially inflate or deflate a stock's price. Insider trading is another dark art. People with privileged information trade on it illegally. This gives them an unfair advantage. Circular trading, where a group trades shares among themselves to create false volume, is also prevalent. These practices erode investor confidence. They make the market feel like a rigged casino for the small investor. The Ketan Parekh scam in the late 1990s and early 2000s was another major jolt. Parekh, a protege of Harshad Mehta in some ways, favored a set of stocks called the K10. He used bank funds and money from promoters to pump up these stocks. This coincided with the dot-com bubble. Technology stocks were the rage. When the bubble burst globally, Parekh's empire also collapsed. The market crashed again. It was another painful reminder that manipulators are always looking for loopholes. The beasts are always lurking, ready to pounce when vigilance drops. Technology has been a double-edged sword for the market. On one hand, it has brought immense benefits. Electronic trading, fast settlement, and easy access to information are positives. SEBI uses sophisticated software for surveillance. This helps in detecting and preventing manipulation. However, technology also provides new tools for manipulators. High-frequency trading can be used to distort prices. Social media can be used to spread false rumors quickly. The cat-and-mouse game between regulators and manipulators continues in the digital age. The challenge is to stay one step ahead. Today, the Indian stock market is larger, more mature, and better regulated than ever before. Participation from retail investors is at an all-time high. India's growth story continues to attract domestic and foreign capital. However, the lessons from the past must not be forgotten. The psychology of greed and fear will always be present. Manipulators will always try to find new ways. Vigilance from regulators and awareness among investors are paramount. The future holds promise, but the journey will continue to have its bulls, its bears, and its share of other beasts. The saga is far from over.